Hi rabbits, Research Turtle here. Today we are dismantling the old map of global real estate. For the past few years, we lived in an era of synchronization. When rates went up, everything went down together. That era is over. We're entering the Great Divergence. The market has fragmented, and we're seeing a split between the Western premium and Asian momentum. If you look at the global valuation landscape for 2025 and 2026, the data paints a stark picture. On one side, we have the established giants like New York and London. They're stable, expensive, and moving slowly. On the other side, we have the chasers, specifically Tokyo and Seoul. This is where the velocity is. While Singapore and Hong Kong are seeing price corrections, Seoul is showing double-digit growth, and Tokyo is waking up from a 30-year slumber. But price per square meter is only half the story. You have to look at the burden of entry. There is a fundamental difference in market psychology between the East and West. In New York, the market is income-centric. A price-to-income ratio of 7 to 9 times is standard. But in Seoul, Tokyo, and Hong Kong, we're looking at ratios between 14 and 19 times. Why? Because in Asia, real estate isn't just shelter. It is an asset accumulation culture driven by structural land scarcity. This scarcity is the universal constraint, but it manifests differently depending on where you look. In Seoul, we're facing a production halt. Construction costs have spiked and projects are stalling, creating a panic over a massive supply cliff coming in 2026. In New York and London, it's an inventory lock-in. Owners with low legacy mortgage rates simply refuse to sell, creating an artificial shortage that props up prices despite high interest rates. Now, let's talk about the money, because this is where the opportunity lies. We are currently in a rare arbitrage zone. The West is dealing with nominal rates of 6 to 7%. Tokyo, however, offers a negative real rate environment with a yen value that has created a 30% discount for foreign capital. This monetary gap is the single biggest driver of cross-border flows right now. But capital doesn't just flow freely, it hits policy walls. Look at Singapore. They've built a regulatory fortress with a 60% stamp duty for foreigners, effectively freezing speculative hot money to maintain stability. Compare that to Seoul, which acts like a funnel. Punitive taxes on multiple ownership are forcing capital to abandon the periphery and concentrate intensely into the core safe assets like Gangnam and Yangsan. This has triggered a specific phenomenon in Seoul, the panic of scarcity. Prices have risen for 47 consecutive weeks despite strict lending rules because the market is pricing in that 2026 supply void. We're seeing a historic decoupling where the core detaches completely from the rest of the market. Meanwhile, Tokyo is operating as an inflation hedge. The lost 30 years are over. We're seeing a shift to an inflationary asset class. It is currently the only major global city with a significant yield gap. You can borrow at under 1% and get a yield of 3 to 4%. It's a foreign capital black hole. Over in the West, New York and London are playing a different game, resilience. New York's prices are firm because of that seller's strike. London is emerging as a value play post-Brexit. Rents there have grown 26% in 5 years, supporting yields. When rates eventually cut in 2026, these markets are coiled springs ready for a cyclical recovery. So how do we navigate this fragmented world? The strategy depends entirely on your objective. If you're chasing aggressive growth and maximizing asset value, your compass points east. The top pick is Seoul's core, buying preemptively before the 2026 supply cliff for a potential 15 to 20% return. The second pick is Tokyo's prime 5 wards, playing the double gain, capturing both real estate appreciation and the inevitable rebound of the yen. But if your goal is yield and preservation, you need to look west. Avoid Seoul, where yields are microscopic 1 to 2%. Instead, look at U.S. Tier 2 cities in the Sunbelt or Midwest for 8 to 12% yields, or prime central London for a value entry with solid rental demand. The days of a rising tide lifting all boats are gone. Success in 2026 requires selective entry based on whether you want the structural growth engine of the East or the cash cow stability of the West. Define your goal and choose your engine. That's it for today. Turtle out.